income statement, simply the profit and loss account. And it all begins from the time you sell. So we're going to use an example of someone selling a product, whatever product. Let's use a phone. So we have a phone business, and this guy buys, let's say he's dealing in only one phone to simplify it. He buys at 300k, right? Then he sells at 350k, right? So what's the difference? And what is at 50k?
It's gross profit.
Yes?
It is gross profit.
Gross profit. So yes, his gross profit will be 50k. Now this guy, let's say, sells 3 phones per day and works 30 days a month. How many phones is he dealing in? 3 phones a day times 30 days is at 30 days one. So this guy, he has some more things he does. Number 1, rent. Pays rent of how much? 1M. Then number 2, he pays the salary. So salary labor. In total, he pays these guys, there are 2 people working, and he pays them 1M in total. Then also, this man also has to pay, yes? Yes, combined. Electricity also per month is, let's say, 500. All of these are per month. Now, we are going to look at this business. We are going to start with first finding what is the gross profit. What is gross profit? How do you get gross profit?
Gross profit. Gross profit.
Yep.
No, it's sales.
Okay, so gross profit is sales minus cost of sales. Cost of sales. This is the language we use when we are what? Dealing with the cash flow. When we are dealing with the profit and loss statement. In other terms, we can say gross profit is total revenue minus total variable cost. The same thing. The cost of sales is the stock. So we don't need to use this for now. So back to this. So it's sales minus cost of sales. So in this example, how do you calculate the sales?
It's going to be the 90 times 300 times 350. 1 times price minus the rent salary. That's the cost.
The selling price, cost price. So here our gross profit shall be 90 times 350 minus our quantity is still 90 times what? 300. So this gives us total sales of 31.5 M, right? Minus the total cost of 27 M. All together? Okay, so our gross profit in this scenario will be 4.5, right? Yeah, that's it. Now, with this knowledge of profit and loss, now we know that this is a gross profit. But remember, we talked of some other expenses. We said he has to pay rent of 1M, salary labor 1M, and electricity worth 500. So we want to go ahead and calculate the net profit. And our net profit, what shall it be? Our net profit shall be the gross profit minus the total fixed cost, right? And our gross profit, maybe let's start by finding the what? The total fixed costs. What are the total fixed costs? Is that correct? Is that it? 1M for rent, 1M for salary plus half a million for electricity. So that's 2.5M. So our net profit in this scenario shall be equal to what was our gross profit? 4.5 million minus our total fixed cost, 2.5 million. And that gives us 2 million. So when we define gross profit, we say gross profit is simply the difference between sales and cost of sales, or total revenue minus total variable costs. Then for net profit, this is actually what you can put in your pocket, which is the difference between gross profit and total fixed costs. Now, earlier we looked at the equation. We said assets equals to liabilities plus owner's equity, right? This is called the accounting equation. Assets equals to liability plus owner's equity. And owner's equity, assets, we know what assets are. They are current assets and fixed assets. Liabilities, they are current liabilities and long-term liabilities. Owner's equity, that's what we want to find out. How do you find owner's equity? And we say owner's equity is the same as, number one, your capital plus, now this profit, under normal circumstances, you're supposed to take that profit out of the business. But if you decide to leave it in the business, it comes and adds to your what? Capital. So it's plus capital. So this is plus profit. Then whenever you decide to go and eat your stock, maybe you're selling food, and decide to eat the food, that means you're reducing on the what? Yes, so minus drawings. That's what we call drawings. Maybe you pick money from the shop to go and buy supper, which you're not supposed to do, or you pick money to go and treat your child to pay school fees. That's a drawing. Or even you pick stock, sweets and what? Those are drawings. So if we go back and look at this, okay, maybe some other equations we can talk about. We can talk of the cost of goods sold. Cost of goods sold. And this is simply you get the value of opening stock and then you add purchases minus closing stock. Let me try to explain how this comes about. So you're a business owner. Let's say that guy, when he started, he had let's say 20 phones, right? And then he bought, let's say 100. Starting, he had 20. Then he purchased, he bought 100. Then closing, had, let's say 30, right? And we're required to find is what? Is the cost of goods. So the opening stock was what? 20 times 300, it is 6M, right? 100 minus 300 is 30M, right? And then times 90, sorry. No, what are we multiplying? 300 equal that. 6M times 300,000 is 30M times 300,000 is 90M, right? Now the cost of goods in this case shall be, what was our opening stock? What was our purchases? And what was our closing? Which gives us? Do we understand cost of sales? Remember, when we are looking at an income statement, we are looking at values. We don't look at quantity so much. We are looking at the value. So, the value of opening stock was 6M. The value of purchases was 30M. The value of closing stock was 9. In normal business, when you close at the end of the year, it doesn't find when you've sold everything. In normal business, sometimes it finds when there are some things left. So that is how we end up with this 27M. And switching. So net purchases.
Net purchases, net purchases minus
Returns outwards. So net purchases equals purchases minus return outwards. Return outwards. In business, if you're operating on a large scale, you expect to buy something and find some which are not okay. So you send them back to the seller. So that difference gives you the net purchases. Now with the net sales, even also when you sell, there are some which won't be okay. So the sales minus the returns inwards. Yeah. So that is on the second one. Now the last one is the cash flow statement. And for it, basically, you want to see how money moves. At the basic level, it's a table with 1, 2, 3 columns. And then you can start with maybe opening balance. At the start of the year, what was your account balance? That is an inflow. So maybe you started the account with 10M. Then after you went and bought stock, what? That will be outflow. Then maybe you sold some funds. That is an inflow. Then maybe you recovered a bad debt. That's an inflow. Like that. If you sell goods on credit, there is no cash movement. So cash flow statements counts actual cash. Are you going to receive money or pay out money? If you go and buy goods on credit, you have not spent cash. So it's not affected. It does not affect the cash flow statement. And now, ratio analysis. So ratio analysis, we look at the 5 categories. The first category is profitability. So profitability ratios. And here, we looked at the gross margin ratio. We all remember that this was the gross margin over total revenue times 100, right? Percent. Then we can also look at a special one, which is markup. Gross profit markup. There's margin. Margin is the fraction of your total revenue, that is your profit. That's what the gross margin ratio is. The fraction of your total revenue, that is your profit. Now markup is the fraction of your cost of sales, that is your profit. Meaning, if I buy this phone at 300,000 and the example we used, we're buying the phone at 300K and we sell it for 350K. The difference is 50, right? Our gross margin would be 50 over 350, right? This is the gross margin times 100. to give us the gross margin ratio. But then maybe I've not yet decided. How much, what my profit is, and I just know my cost. And I say like, how much do I want to make from this? So for my 300K, I want to make 50K. What do you get? This is 6, 1 out of 6. What percentage is that? 50. Here we got 14%, right? 14 point something percent. Here, what do we get? 16.67. So markup, how is simply how much do you want to make from what you've put in? So from, if I buy a phone at 300,000, if I want to make 16.67%, that means I will sell it at what? The extra 50. So markup is what you're adding. Margin is of the total revenue. What do you keep as what? Gross profit. Gross profit markup is like of the total of the amount I put in to buy. How much can I make? In simple terms, gross profit markup is gross margin divided by the cost, total fixed cost, total variable costs, or you can call it cost of sales. In simple terms, our markup is simply gross margin divided by the cost of sales or goods sold, and gross margin ratio over total revenue. This cost of sales can also be the what? Total variable cost. Yes. So profitability, return on capital employed, the ROS, return on capital employed. This is simply net profit divided by the sum of total equity and long-term liability. Because capital employed, remember capital employed. Capital employed is what? Capital employed. This is the capital that is working for you in the business. So this one is the sum of total equity plus long-term liabilities. For example, let's say this business selling what? Phones. This guy has put in capital of 10M and goes to the bank and gets extra 5M. So you find that his capital that is employed in the business, that is working in the business, is higher. It becomes what? The amount he has put in plus the amount he has borrowed, which gives us capital employed. Now return is what you get. So what you get out of capital employed is the net profit divided by capital employed. The next one is the return on equity. When you say return, net profit divided by total equity. Return on assets. This one is different because when we are talking of assets, we now look at in terms of sale. Return on assets, which is sales divided by total assets. Then we have liquidity ratios. There are only 3 basic ones. Liquidity is just your ability to pay your debts. That's it. In short term, in simple terms, liquidity, ability to pay debts. So the current ratio is the simplest, which is current assets over current liability. Then there's quick asset ratio. Quick ratio. If you had to, remember, current assets include stock, but we know that very well that it's hard to sell your stock. So if you had to get money quickly, what you do, you remove the stock. So the asset test ratio or the quick ratio, asset test or quick ratio. Here we say current assets minus closing stock divided by current liabilities. Then for working capital, not ratio. What is working capital? The difference between current assets and current liabilities. So working capital, current assets minus current liability. Oh, we have some others. The rest, I think, Time has gone. Okay, let's finish there. Solvency ratio, I'm just going to go through them. So liquidity ratio is your ability to pay your debts in the short term. Solvency is your ability to pay debts over a long time. And solvency ratio, the first one is debt ratio, which is simply total long-term liabilities divided by total assets. Then debt to capital ratio. Now here we are comparing total long-term liability divided by your long-term debt plus equity. That's capital employed. Debt to capital ratio is a debt to capital employed ratio, isn't it?
Confusing.
Debt to capital ratio. What is it?
No, no, read that right. I'm here.
Okay. Debt to capital ratio is simply total debt divided by capital employed. Remember we said capital employed is equity and long-term liability.
For me, I know this one. Capital employed is working capital plus what?
It has two formulas, I don't remember it. I don't remember the other one. Then equity ratio, still equity over working capital.
Working capital plus. I'm forgetting the other one.
Next, efficiency ratios. Efficiency ratios, there are 4. There is debt collection period, how long it takes you to collect your debts. That is your total debtors, people you've given money to or given things on credit, the value divided by the total sales times 365. So you find the number of days it takes you to get your money back. Creditors payment period, same thing. Total creditors, people who gave you goods on loan. Your creditors divided by your total purchases times 365. Then the other one is stock turnover, which is simply cost of sales divided by average stock. How many times does the stock what? Do you buy and sell your stock? So if in total I've sold 100 M and always I have stock of like 10 M. That means if I say I've sold stock of 80 M and I have stock of 10 M always, that means I've bought and sold stock 8 times with that 10 M. Then stock turnover. Stock turnover is like how many times do you buy and resell your goods. If in total the goods are bought are worth 80 M, but my stock, my average stock, what I hold, the on average is 10 M. That means I've bought and resold 8 times over that period it took me to sell to buy the 80 M. You've got it? It's simply cost of sales divided by average stock. Yeah, then inventory turnover is the opposite of what? Okay, inventory turnover is the opposite of stock turnover, sort of times 365.
That's what it is.
Inventory turnover, there's stock turnover and inventory turnover. Stock turnover, number of times you buy and sell. Inventory turnover is how many days stock stays for with you in the shop, which is average stock now goes up and cost of sales comes down times 365. Then lead time is the time between ordering and receiving.
No.
It differs, depends. You just measure and you see.
Lead time.
Hey, mama, the time.
Now, the last category. Remember the first one we said was profitability. Then we looked at liquidity, which was current liabilities. Then we said debt, which was long-term. Solvency, which was long-term. And now we looked at efficiency. Now we're going to look at the last one, which is shareholder, and it has only 2. The one is earnings per share. Remember in corporation, ownership is divided in shares. So earnings per share is simply the profit after tax that the company generates divided by the number of shares, ordinary shares. You get earnings per share. Profit is what you earn. So per share divided by number of shares, ordinary shares. Then dividends per share. Because there is profit, but not all the profit is what? Is distributed. Some is reinvested. So dividends is just profit that is given to the shareholders, which is dividends paid divided by number of ordinary shares. So with that, we're okay. Next we shall continue. I think the next time we meet we shall be on questions purely. So you go and look at
Tomorrow.
the rest.
Tomorrow, from 8.
Monday.
Monday.
Go and read.